you're in the world. Welcome to another financial modeling brought to you by UrBizEdge. For today's subject, we'll be having timing and equity injection in a project finance deal, and our special guest is Hedieh Kianyfard. Together by collaboration between Financial Modeling Institute and UrBizEdge. So for some of you that are interested in writing the AFM exams and also the CFM exam and also the master, that's MFM exam, you can also check out Financial Modeling Institute website. So UrBizEdge is also a registered Microsoft Excel consultant, financial modeling, business intelligence, data analysis, and enterprise solution here in Nigeria. We specialize in helping companies and high-value professionals be on top of the business data. Also, UrBizEdge is also the developer of Nigeria Financial Market Tool and also Nigeria Market Data. As you all know, we're also a training company here in Lagos, Nigeria. So this is our calendar for our upcoming training. So the 23rd to 25th of June, that's Thursday to Saturday, we're having business intelligence and dashboard using Microsoft Power BI. Also on the 24th to 25th of June, we're also having big data analysis, Power Query, Power Pivot, and VBA in Excel. Also on the 25th to 26th, we're also having AFM, that's Advanced Financial Modeler, and also a mock exam. So I'll just give a brief description about our special guest today. Author of Model Detective book. She's author of Finance Model Detective book. Hedieh has made financial modeling a profession and also a passion. She has worked since 2008 as a financial modeler and has led financial modeler for several mega greenfield projects in Africa. So no further ado, I'll hand over the section to Hedieh. So Hedieh, over to you. I'll stop sharing my screen.
Perfect. Thank you. And thanks everyone for joining. I'm just going to share my screen and let me know if you can see the screen, please.
It's visible.
Yes? You're good?
Yes.
Perfect.
Visible, yes.
So again, hi, hello everyone. Thanks for joining. So before I get into today's topic, which is about the disbursement order and the timing of equity injection in a project finance transaction, I just want to share with you something which is very important to me. And it is mainly my main aim when I'm publishing something, whether it's on my YouTube channel or it's a blog post that I write. My main aim is to kind of convey a message, and that is to remind everyone that the financial model is more than just a document in a checklist, and that a project finance model or any financial model is a tool that is used by different stakeholders in a project so that they can evaluate the riskiness of a project from their own point of views. And a good financial modeler, by the way, we just want to say that we can start. Okay, there is an echo. I don't know whether it's from my end.
I'll try and mute the person now.
Okay, perfect. So yeah, so the message that I want to give to you is that, if, a good financial modeler needs to have access, needs to be involved in a project and needs to have access to different project documents. Because sometimes I see in the industry, there are companies that they either hire a consultant or they have somebody in-house that's doing the financial model for them. However, because of their mindset, sometimes they kind of isolate the financial modeler from the discussions that are going on around the project. And to me, that is why we sometimes face with models that are either oversimplified or over complex, because if tomorrow, a client comes to me and asks me to build a financial model for them, and however, they don't give me enough information, the best that I can do is to give them a flexible financial model. Because of my experience, I know that there might be discussion going on around different topics. So I'm going to build all this flexibility into this financial model. And because there is a trade-off between flexibility and simplicity, so the model is going to end up to be very complex, because of the flexibility that I want the model to have. And my personal preference is to have a more simple model, a model that anybody can work with it, a model that you don't need to wait like 5 minutes for the macro to run. And that is why I really think that it's important, that the financial modeler is involved and has access to all the project documents so that, you can build in these flexibilities as you progress, with the project. And today's discussion, that's why of course, we're going to discuss about this topic. First thing we're going to do, we're going to look at this different disbursement order mechanism that I have seen in the project that I was involved in. And then I'm going to show you clauses from the different loan agreements. And then we're going to see the commercial impact of it by using a financial model that we're going to go through. And I can also share the link where you can download the model and look at the calculations yourself. So without further ado, let's get into the topic itself. If you don't have any questions, please step in. As I said in the beginning, you can just step in and ask any question anytime you want during the presentation.
Salman. Okay, let me see.
All right, so the first thing that I want to say here is that, a project finance deal, you have these different phases, right? So we have this development phase, which is like, some people, a group of people, one or two individuals who have an idea, they want to build a power plant, they want to build the road. And at this development stage, sometimes idea stage in the beginning, so they need to get all the patents and all the they need to do all the studies to get the project to the financial close. Most of the time, up to this point in time, it is the equity that is putting all the money to finance all these studies, to do the site visits with the lender and everything. But once you reach financial close, which is an important date in the life of a project finance transaction, then from then on, you're dealing with different stakeholders, right? The main stakeholders are the lenders, which are the debt providers, and there are the equity providers, which are the shareholders. So these people will have different round of negotiation around different topics, okay? And one of the main discussions that they will have is around the budgets, for the construction of the asset that they both want to finance together. So the sponsors, they're going to come to the lender and say, so this is the project that I want to build. This is the financial model, and this is how much it's going to cost to build this asset. And then the lender is going to come back and say, okay, I'm going to come and, be with you in this project, and I'm going to give you a maximum of 70% of this total project cost, 80%, 85%. So they're going to kind of size the debt based on a maximum gearing and other criteria. So far, so good. So the debt is sized. Then the next question, which is the topic of today's discussion, is, okay, so we know how much they're going to fund, the lenders, but when do you want me as the lender, the equity, or asking the lender, when do you want me to inject the money? Okay, so that's the question. We know how and we know when. We need to know when the money needs to be injected, because the construction phase is going to take time, right, to build the asset. Sometimes 3 years, 2 years, 5 years, depending on the type of asset and the size of the asset. It's going to take, a certain time to build it. So throughout this time, we want to know when should the money be injected. So from the point of view of equity, let's see what is, at the advantage of an equity holder. So equity holder, if you ask them, they prefer to put their money last, right? Because there's a time value for money. And if they put their money last, the return is going to be higher. Also, remember, there is something called risk, which is the most important, factor in all the structuring of deals is the risk. So when you're, the risk profile is changing through time. When you're at the beginning of a project, when you're at financial close, you didn't build anything yet. So you're dealing with a piece of land, right? So if you start putting money at that point in time, it's going to be riskier than when you have already a half-built asset, right? If you come and you put your money at that point in time, it's going to be less riskier. Because although you have done all the studies and everything, you know about everything, but once you really start drilling and, digging, then there might be some unexpected events that's going to cause overruns and everything. So that's why when you're half done with the construction, that the risk is going to go down and down until you reach COD or commercial operation date. So from the point of view of equity, they prefer to put their money last. So now let's see what about the lenders? What is their preference? Lenders, they're going to earn interest on the money that they're going to put, right? So for them, they prefer the equity to put their money first. And why is that? Because it's a partnership. The lenders are coming into a partnership with the equity in a project finance or any kind of deal. And most of the time, lenders are majority shareholders, right? Most of the time, they finance 70%, 75% of total project cost. So they will be majority shareholders. So they want to see that, the equity is invested in the project, and you are not invested in something unless you spend money on it, right? So that's why they say, I want to see some skin in the game. I want you to put your money first so that, I know that you are invested and you are involved in this project. So imagine these two mentality, they come together and they start negotiating, and they will see where they're going to end. And we saw this two extreme cases, and around this there are also some other alternatives that we're going to show here together. So if you don't have any question, we're going to go and look at the first option, that is if the lenders, they ask equity to put all their money upfront. Okay, so the upfront equity injection. So the first, I'm going to just take you through extract, these are from a real loan agreement, which really tells us, that the requirement by lenders is to have an upfront equity drawdown. So the extract says, borrower shall provide evidence in a form of satisfactory to bank of borrower's 30% equity injection paid upfront and prior to borrower requesting any loan advances from the bank. So as you can see here, by reading this clause from this loan agreement, you know that the lenders, they require full 100% upfront equity injection. Okay, so now let's look at a numerical example and see how it's going to look like when we have a project. So we're going to follow this example through all these different options, six options that we're going to go through together. If you're dealing with an upfront equity injection, for example, here we have a project that is costing 1 million, let's say, and it takes like 10 quarters, around 30 months to build the asset and finish the construction of a project. So this 1 million is spread through these 10 quarters. And now if the lenders, they say that we want 30% from equity and we want it to be upfront, this means that during the first 3 quarters in this example, all the money needs to come from the equity buckets. And once we finish, we use all the equity, then, the lenders, they can come and inject their money. And we're going to look at a chart that's going to show us as well. Maybe it's going to be more visible. So you see here that we start the construction with full equity. Then we still, in the second quarter, we have equity. And then because we have already used the 30% equity, so all the equity came up front. Now the remaining construction is going to be funded with debts only. Okay, so that's the upfront equity injection. Now, the next option that I want to discuss is the pro rata. Okay, what is a pro rata? Pro rata is that, the lenders, let's first look at this extract from the term sheet and see whether we can understand the concept. So in a pro rata disbursement, the definition from this loan agreement that I extracted for you here, it says that the borrower shall draw down senior loan on a pro rata basis in accordance with the senior loan commitment under all of the senior loan agreement, except in the case where the amount of the borrowing must be greater than what would otherwise be required under this section due to the minimum disbursement requirement set forth in the various senior loan agreement. So you see here, this is saying that, okay, we allow pro rata drawdown. However, we need to just make sure that, because, you know, when you are reading the loan agreement, of course, there is a clause, you know, for the disbursement, but you need to also be careful because there might be some other limitation as well. So, for example, in this case here, there is another place in the document where they mention that there is a minimum disbursement. So, for example, you cannot go to the bank and, you know, ask for $10,000. They say, at least, you know, you come to me when you need like 500,000. You come to me when you need $1 million. You cannot come to me with an amount less than such a, you know, amount. So that's why, you know, it mentions here it can be pro rata provided that you are basically respecting the other clauses in this agreement. Okay, so pro rata, it's very easy. So you are now looking at the same example, numerical example that we had with the 1 million project. When it is a pro rata drawdown, you know, in each disbursement request that you have, basically, if the gearing, for example, here, the maximum gearing required by lenders is 70-30. Okay, so 70% debt, 30% equity. And that's how you size your debts. So in each disbursement request, you're going to go to the lenders and say, okay, I'm going to put my 30K and I want 70K from you. And when you look at the chart, this 70% gearing is maintained throughout the construction. Okay, so unlike the previous one, which, you know, the gearing was, you know, building up until it was reaching 70%, this is 70% throughout the construction program. Okay, I hope these two were clear. These were like something that, you know, we are most familiar with. Now, option 3 is the, it might be, you know, I have seen these cases in 2 of my project. This is pro rata, withdrawing on the debt, but with the percentage lower than the gearing, resulting in a faster drawdown on equity. I mean, the name is a bit too long, but basically I call it accelerated pro rata, and we're going to see why we call it accelerated pro rata. So first, let's look at this extract from the loan agreement. So the first clause, you know, F and G, they are the typical one from pro rata that we have seen. It's just a definition of pro rata. But I want to bring your attention to the last one, I, which talks about this nuance that I, you know, mentioned in the title. So it says planned project cost shall be funded A, by base equity contribution in an amount equal to 55% of the aggregate amount of planned project cost identified in such a notice of disbursement, and B, by senior loans in an amount equal to 45% of the aggregate amount of planned project cost identified in such a notice of disbursement, provided that at no time shall the total project cost funding request exceed 3367. So you see there, the wording is a little bit complex, but what it says is that at each disbursement request, 55% should come from equity, 45% should come from debt, and when you're sizing the debt is going to be 67% of total project cost, and equity is going to be 33% of total project cost. So by definition, without even going through the number, you can understand that, okay, so most probably in this one, that's why it is called accelerated pro rata. I'm going to use my equity, you know, faster than in the pro rata case, okay? So let's look at the numerical example. It might be a little bit, you know, better, you know, easier to understand. So let's look at our same numerical example of 1 million project. So in this one, let's say that the lenders, they say, okay, I'm going to provide 70%. So it's the same example. 700K is going to be from debt and 300 is going to be from equity. So we sized our facilities. Now the question, how am I going to inject? So lenders, they say, equity, I want you to, in each disbursement request, you put 40% and I put 60%. Although the gearing is 70-30, but I want you to put more than me, you know? So in this drawdown, you will see that you have 40% drawdown on equity And then at some point in time, the equity, you have used all the equity facility. So now you're going to tap into debt, and the remaining construction is going to be funded with debt only. So you see here at the beginning is 40-60, 40-60. And then once you reach half of the construction, almost more than half, then you are only left with equity, debt only. So that's how it is. And that's why I call it accelerated pro rata. We have now option 4. Option 4 is that the lender, they say, okay, pro rata is okay. I accept pro rata. Remember the option 2 we talked about. But however, I still want you to put some upfront, I want you to put a percentage upfront so that I know that you're committed. And then the remaining we can do pro rata. Okay. So let's look and extract from a term sheet. So this loan agreement that I extracted this clause from, it was in a draft, it was still in a draft version. So that's why the numbers are in brackets. So once, the financial model is finalized, the discussions are finalized, then, the numbers are going to be plugged into the loan agreement. So the clause says base equity will be contributed in an amount equal to at least X prior to financial close. So this is the definition of upfront equity. And thereafter, pro rata with utilization under the term loan A facility. Okay. So that's also pretty clear. You put some money upfront, remaining, we're going to do pro rata. In our example of 1 million project cost. So for example, if the lenders say, okay, the first 100K, you put it upfront, I'm not going to come in. Once you have you have put the 100K, which is 33%, then, I'm going to come and we can do pro rata. Okay. In our table, you see that the first one is the green one is equity. So it's coming completely from equity. And then we have the pro rata with debt and equity. And if you look at the curve, which is showing the gearing is slowly going. And at the end of the construction, we reach the maximum, which is the 70%. Just bear in mind that these checks, you need to put them in your financial model as well, because it's very important that you don't go beyond the 70% in each construction phase. In each disbursement request, the lender are going to check that you're not going beyond the maximum 70% that they require. So, okay, so we looked at the option 4. Now option 5 is the same as the option 4, but there is a little nuance here, and it is what I call the pro rata with the catch-up. Okay, and we're going to see what I mean by a catch-up. So in this one, it says utilization request is a definition of utilization request in the loan agreement. It says to the extent a sponsor has fully funded its commitment percentage of the total base equity commitment at financial close, the definition of initial shareholder commitment, the borrower shall be entitled to request a disbursement under up to the amount required to restore the debt to equity ratio of 75-25. So you see, this one, it says that you put your initial upfront equity, and then debt is going to come in until you restore the debt to equity ratio. So the key word here is to restore, okay? So we're going to look at the numerical example, and it will be maybe easier to understand the concept. So for example, in our example, lenders, they say, okay, you will come and you put your upfront equity. This is done here in this quarter, January, March to 2022. So you put your 100K, and then after that, we have this catch-up period, meaning that the lenders, they're going to put their money until, you reach the 70-30, and then it's going to be pro rata, okay? So that's also an interesting, profile that I have seen in the project, and you will see later when we go into the Excel and the financial model that the impact on the equity IRR is quite high. So it's the upfront equity, catch up with debt. Once you restore the gearing, then it's going to be pro rata with debt and equity. And the chart is going to also show you that you see that in these 2 quarters is going to be debt only, and that is what I call a catch-up period. And in the term sheet, in the loan agreement, it says to restore. So we are putting debt until we restore the 70-30, and then afterwards completely a pro rata drawdown. So the last option that I want to show you is still, we're going to still put this upfront, because across all the projects that I've worked with, to be honest with you, there's always this upfront equity requirement. However, I have seen, cases where in project finance, private sector, I have seen that, if you have like a concessional loan, sometimes they allow and debts, first disbursement from debt before equity. And that is because, the purpose of a concessional loan is to help the project from one way or another, whether it's to reduce the tariff or somehow. So if you inject debt first, it's going to maybe help the project as well. So they might be more flexible in all the terms. Of course, the interest rate will be lower as well. So also in the drawdown orders as well, the concessional lenders might be more flexible. So this is just a side note. So I couldn't, with my current project, I couldn't find, a wording for this upfront debt injection. So I thought maybe that's a good point also to mention here, that sometimes when you read the loan agreements, they don't have a definition, for the disbursement order. However, they refer to an annex or a schedule in the agreement, which gives, the exact disbursement order with the dates, percentages, or the amounts that will need to be disbursed, during the construction. So sometimes it's also, you will see that the table in the loan agreement, and that should be, basically it's coming from the financial model, but that's the one that you need to also use in your financial model if that table already exists in your loan agreements. So in our numerical example, we again have that upfront equity requirement, which you see here that upfront is injected. Then you see that the remaining construction is going to be debts only until we use all the debt facility amount, and then equity is going to come last. So you can imagine the impact on the IRR for this one as compared to the previous one, but we're going to go and have a look at it in a financial model as well. And in this, just in terms of in the graphic, or you can see in the graphic that this is also debts, debts, and then once you are in the last 2 quarters, basically you're going to fund only the project cost by using your equity facility. Okay, so before we go into Excel, and also I can open to questions if you have any. I just want to make some side notes here. When you're building this disbursement in your financial models, before you even start building the mechanics, if you're involved in a project and that you have already approached some lenders, or there are some specific lending institutions that you are targeting, it's always good and check. They have something called Disbursement Manual. Most of the institution, they have it. So I really recommend that you go and check that manual or ask for it. Most probably, if they don't publish it online, maybe they have it somewhere they can share with you. You need to read that, because some lending institution, sometimes they cannot finance some of the cost items. So you need to take that into consideration when you are building your financial model and you are building this disbursement profile into your financial models. So that's why, again, I emphasize that, as a financial modeler, you need to be involved in the discussion and, be able to ask questions and, get feedback from different stakeholders. Okay, and these options that I mentioned to you, and it's going to be also available in the spreadsheet that I'm going to share with you. They can be a good starting point, to build into your spreadsheet when you're starting. Even if you didn't maybe consider, approaching lenders, these are the options that maybe you can build into your financial model and consider. Okay. However, just note something that, it's very important to know the sensitivity of your investors when it comes to injection. For example, if you're dealing with a project which only takes 6 months to build, which is the case sometimes with small scale, solar projects, solar PV, which takes 6 months, 4 months, whatever to build. So maybe when you're dealing with such a project, the investors will not be that much sensitive, because it doesn't make much difference if they put all their money up front or they put it last. Okay, so it's also important to also know your investors and know how much sensitive they are to such a subject. Or sometimes funds, equity funds, by nature, they cannot put pro rata. So they need to put all their money up front. So that's also something that can make your life easier from the beginning. You're just going to put in upfront equity and it's going to be the end of the story. Okay. Then again, I just want to emphasize that you really need to read the loan agreement, because there are so many things that are included in the loan agreement that you need to include in your financial model. For example, the number of disbursements. Sometimes we build our models on monthly basis and we model a monthly disbursement. But when you read the agreements, you see that they don't allow, there is a maximum disbursement request that you can send to the lender. So that's going to make a difference, that you need to take into account in your financial models. And another just side note is that I think we all know by definition, we know that you can ask money from your lenders, meaning that these documents that we send, the disbursement request that you send your lender, you can only send them once the financial close has reached, right? Sometimes there is a delay between signing of the loan agreement and the actual financial close. So you sign the loan agreement, everybody's happy, you pay the upfront fees and you start paying the commitment fees as well. However, you still didn't reach financial close. So if there are any costs in between signing and financial close and the delay is long, you need to consider that these costs need to be funded with equity only. And once you reach financial close, that's when you can start, sending your utilization request and get the debt, to fund the project cost. Okay, so I think that's it for the theory now. It's a quick discussion also around the financial model. So if you have any question, please, let's have the question now, and then we're going to get into the financial model.
Okay, so Hedieh, thanks. Okay, Mike, you want to go?
I wanted to point out, should we read out the questions that are already there?
Yeah.
I think someone has a question. Okay.
Yeah, that's not to read. Okay, so someone's asking that would like to know your thoughts on these two things. Circular reference, can we bypass them? And also flexible and dynamic array based model.
Okay, so this is getting into the Excel, which we can discuss while we are looking at the Excel. And actually, you will see in the Excel templates that I have, which is actually when I was reviewing, it is a kind of a complete project finance model. So I'm happy to share it with you. And it actually contains a copy and paste code because unfortunately, that's how we are resolving the circular references, in the model. There are some, just a side note, it's a very complex topic, but there are some other solutions to resolve for circularity. But for now, what is common practice is to have this copy and paste. And you will see that, for example, in this model, it's a simple model, but it's a functional model. You see that it's quite fast. When you attach the macro to the button, you will see that it doesn't take much time. And but yeah, so circularity, most of the time it is resolved by using the copy and paste. However, if you're interested, write to me and I can show you some other more complex but much more efficient way to resolve circular references in project finance models.
Okay. So that's the only question so far.
Okay, and if anyone wants to unmute and ask, yes, feel free. Hedieh has been very generous to let us know that all your questions are welcome. So going on, let's give you like 5 seconds. I even have a question, so I'll take the opportunity. And my question is, like you mentioned, there's a preference. You say a lot of in most of all these project finance dealings, the real world ones, they usually want to have the equity injection upfront. And so I just want you to tell us a bit more about the common things you find on the term side before we go to the Excel side, beyond the ones you've mentioned. So what are the very common structuring that you see, maybe by generally or in some segments, in some sectors? And it's very interesting to always hear that. That's my question.
Sure, thanks. That's a very pertinent question. So yes, what I have seen and what I'm mostly modeling in my financial models and I see in the deal, as I said, if I'm dealing with senior lenders, most of the time they require an upfront equity for sure. So that's something that I have seen. And also, I mean, I didn't want to get into it, but remember that, we have this phase which is called development, right? So during this development phase, these developers, they have already spent money on developing the project. I guess I mentioned that, the studies and everything, sites, visits and all the stuff that are going on until the project gets into financial close. So there's a lot of money already spent on that. So sometimes, I mean, in most of the cases, this money can come and can be claimed as project cost, okay? So that can already be counted as an upfront equity because it was money that the developer, they have spent, and somebody even came and bought the project from the developer, or it's the developer himself, is a developer that is coming and building the project as a shareholder, is continuing. So that money that has been spent can be claimed as the total project cost, and it's going to be considered as an upfront equity, okay? So the lenders are going to be very careful with these costs. They're going to audit them one by one, and they're going to say, okay, these are recognized. I can say that you have already spent this on this kind of external cost, that you hired all these consultants. So I'm going to recognize this as your equity, and we're going to put it as the project cost. Okay. So when you look at the sources and uses of funds, you have on top, you have the project development cost as an outflow, and as an inflow, which are the uses, you have upfront equity. So that's going to be already an upfront equity, okay? And on top of that, maybe lenders, they can even ask for more upfront equity so that, if they really want skin in the game from the sponsor, they can impose even more than that from the equity. So definitely upfront equity is something that I have seen across all my projects. And so upfront equity plus pro rata. So with catch up and without catch up. So these two methods that I have told you are the most common ones. And of course, upfront equity, totally upfront equity, I have seen in projects, as I said, small scale project, which the investors, they came and said, I mean, no discussion. I agree with 100% equity. I'm going to put my money first. No big deal. So these are the three ones the main one that I have seen. And the other ones also rarely I have seen. It's like, for example, the upfront debt. When I have concessional lenders, most of the time they say I'm okay with upfront. I can come upfront to help the project, have a lower tariff and all that. So that's the case with the concessional lenders.
Thank you very much.
Yep.
Okay, so I think we should let you go to the next phase.
All right. Okay, so now we get into Excel. So you're going to have this financial model. So this is the input sheet. So I'm going to scroll down to the financing assumption, and that's where I am building my financing assumption. So the 6 methods that we went through together today, I have included them in my input sheet. And I have included a switch, which I enable the user to switch in between these 6 and, choose any of them. Okay. So once you build this into your input, now you need to go into your calculation sheet and just, calculate all these different profiles, okay? And this is done in the financing. I have already done it. I say it's going to take time to build it, so you can just go and, review it on your own. But basically, once you do that, then, in your financing sheet, when you're doing your sources and uses of funds, and as you can see here, unfortunately, I have a copy and paste code with a button that you need to run. So these are hard-coded, and actually it is always better when you have a copy and paste to to basically color code it differently so that the user knows that this is not hard coded, but it's actually an output of a macro. Okay. So yeah, so once you have that, then you're going to come and build the flexibility in your model so that the user can go and check any of these disbursement profile. So just to give you an idea, I put it in form of a chart. So I am now in my 100% equity upfront. So you see that in this case, all the equity is coming upfront, and then the remaining is going to be from debts. Pro rata in this project, you see that we are maintaining the 70% all along the construction program. Accelerated pro rata is where we have a kind of a pro rata drawdown. However, it is more accelerated. And as you can see here, we're going to use all the equity when we reach the 6th quarter in this project. Then we have this fourth one, which is the equity upfront without any catch up. Okay, so that one is we're going to exhaust the equity and then we're going to continue the project with funding with debt. Then the catch-up period, which I really like it, I have seen it in a couple of my projects, is the one that you have some upfront equity, then you have a catch-up period with the debt, and then it's going to be pro rata with debt and equity. And the last one is going to be this equity upfront, you know, with some equity upfront followed by debt and remaining with equity. So as you can see here, we have this upfront, then it is debt coming all in, and then the last, quarter we have some disbursement from the equity. So what I want to show you here now, modeling it, as I told you, you can go and check it out on your own. What I'm going to tell you now is we're going to go and see the impact of these different disbursement orders on the equity IRR. Okay, so I am using this worksheet, which is called scenario output. This is just a very simple worksheet with a copy and paste just to record, the different scenarios that we're going to do. I actually got it from Professor Edward Bodmer's website, which I can also share with you if you don't know him, and you're interested in financial modeling, project finance, and even corporate finance. It's a very good source to go and check out the materials on his website, which is edbodmer.com. I can share with you later. So I'm going to come here because I want to send it in an email to, my team and tell them that, okay, guys, we are preparing for a negotiation with lenders. So let's see the options that we can go and, see the impact on the return. Okay. So in preparation for that meeting, I'm going to come and prepare these different scenarios. So if I have 100% equity, as you can see here, the equity IRR in this option is 14.86%. Okay, so I'm going to save this one. Now I'm going to test it on the pro rata. So in your opinion, what's going to be the equity IRR under pro rata? Is it going to be higher or lower than the upfront equity? If anyone is interested to answer. So pro rata, if I now, yes.
Okay. Well, I think the pro rata should have higher IRR than the equity upfront.
Exactly, that's perfectly correct because you're putting less money up front, So we see here that exactly you're correct. It's going to be 15.6%, as opposed to 14.8%, 9%. So we're going to also save this one as our option 2. And now we're going to go and check the what we call accelerated pro rata. So this one, what do you expect compared to the few, just pure pro rata? Do you think IRR is going to be lower than option 2 or higher than option 2?
Maybe in between.
Maybe in between the two. Okay, so you see here because it's accelerated, so it's not going to be exactly the same 70-30 70-30. You impose a higher portion from equity, that's why it's called accelerated pro rata. So it's going to be higher, as you said, higher than option 1, but it's going to be less than option 2. So we're going to save this one as well under option 3. And now this one. So now we're going to get into these scenarios with a percentage upfront, remaining pro rata. So remember, we had one which was without catch up. So this one, how do you think this one is going to look like?
Yeah, this should be worse than all of them. I'm thinking it should be less.
Exactly, yeah. So this one is going to be a little bit better than upfront. All of them are going to be better than upfront, because upfront is, you put all your money, upfront. So that's going to be the worst in terms of equity IRR. But this one is a little bit better than this one, but less than all of these ones. Okay, so let's save this one as well. Now, this one that I told you I like, this one is the upfront, but with the catch up. So you say that you put your upfront, but then, there is a certain period of time that debt is going to say, okay, I'm going to come in, put all the money until we reach the gearing. So how do you think this one is going to look like in terms of IRR?
Maybe it will be better than the upfront and also better than option 4. But I don't know. I don't know what else to say beyond that.
Yes, that's perfect. Yeah, so this is the one that is closer to option 2, which is a pro rata, okay? Because you still have some upfront requirements. However, because, in this, let's look at actually, I had to bring the chart, sorry, it might have been easier to visualize. Okay, so you see that in this upfront with catch up, you still have these upfronts, but you have these 2 quarters, which is debt only. So equity is sitting and it's not injecting anything, and then they need to come in later. So this is better than the, sorry, I didn't save it right yet. Okay, so that's option 5. So this option 5 is better than, of course, all these 3, but it's worse than pro rata, a little bit worse than pro rata. Okay, so it's the closer to pro rata that we can get. So if you have this option in your project with your lender, that's quite a good one. Okay. And of course, the last one, what do you expect in the last one? The last one is just equity, debt first.
Thinking this should be higher than option 5.
Exactly. So this one is the best one, right? This one is the best one because basically you don't put much equity and all the debt is coming up front, and then equity is just putting the remaining at the end. So that's going to be the best one when it comes to the disbursement. So as you can see, because it's a quite long construction period, it's 30 months of construction, so the impact is quite high on the return. So you see that there will be a lot of discussion around this topic with the lenders and sponsors, and when you look at the impact on the IRR, you see now why there is the importance of this topic. So when the lawyers are sitting and they're just talking and putting all these legal terms, difficult terms, talking, so behind it there is a commercial discussion that needs to be handled, and this is the commercial discussion that you can have with your team by sending such a kind of table, and then you see that the discussion can go much smoother by looking at the numbers and figures from the financial model. Okay, so I think I'm done, and we're going to open also to more questions if you have.
Oh, thanks a lot. So I know people in the house who I'm sure this is a topic of interest to them. Yeah,
so someone's asking, okay. Someone's asking, how do you deal with variation in project costs during construction as regard equity and debt funding?
Excuse me, Temidayo, can you please repeat your question?
Okay, so Sadiq is asking, how do you deal with variation costs during construction as regard equity and debt funding?
Variation in project cost during construction. Variation. Do you mean like? Okay, so that I need some clarification. How do we deal with variation in project cost during construction as regards equity? Yes.
Okay. So I think let me.
Yes.
Can I unmute the person?
Sure.
If he's still in. So Sadiq, I stay in.
Okay. Yeah. Thank you. I'm very much here. Thank you very much for the insightful presentation. It's been very enriching, and is an area that I am very much interested. What I'm talking about here is when you have a variation in cost, maybe at the initial stage, a project cost $100 million, for instance. Then during the construction, you discover that it has escalated to 120 million. Now, at the conception of the project, you have already mapped out how you are going to fund the project. You have gotten the equity funding, you have gotten the debt funding aspect. So how do you now cope with the extra cost that is happening?
That's very interesting topic, very interesting advanced topic that you are discussing. So first thing that I can say is that, when we are in the appraisal stage, meaning the prior to financial close, so the lenders and sponsors, they look at the construction budget, and there will be a lot of discussions around the budget, okay? So what is the cost that is going to go through this, EPC costs, this cost, and they're going to identify all the costs that they can and have a very detailed breakdown of all the costs that are required to bring the project to operation, right? So they're going to identify all the costs. And on top of that, so there are some we call physical costs, which I said, the advisors, the hire contractor, blah, blah, and then insurance. And then there are some financial costs as well, financing costs, interest during construction, commitment fees, PRG, PRI, whatever. So all these costs, you're going to put them there. But on top of that, remember, there is always this contingency provision, right? So the lenders and sponsors are going to sit down together. Lenders, they have their own technical advisors. Sponsors, they have their own technical financial advisors. They're all going to sit down together, and then they're going to, there is another topic of discussion is about this amount of contingency, okay? So they're going to come up with the contingency. They're going to say, okay, we're going to put 5% of EPC as contingency provision. And that budget is going to be there. In case things go wrong, right? So in case things go wrong, you can still, so this is already sized in these total project costs, and in all the disbursement profile, you have already put that contingency in. So if the project goes up by the total amount of contingency or below the contingency, you're still fine. The problem is when you go beyond this contingency, right? So which happened a lot, unfortunately, during the COVID time with all the delays. So most of the projects are being restructured because of the delay. And, you have, all these overruns, which is going to cause you to go back to the lenders and ask for a restructuring, okay? So if you are below the contingency, you're fine. Of course, there are variations, none of the project goes as planned when it comes to the cost. There are always cost overruns. And because of that, you have this contingency. And then if it is beyond the contingency, then also, not only the contingency which is funded, there is also another bucket which is called, which is coming from equity only. So they say that, okay, equity, you put the 30%, but if things go wrong, you still need to put 5 million, okay? So there are different layers of contingency built into the deal, there's not only that. So unless things go very wrong, then as I said, you need to go and restructure the deal. But prior to that, you have the contingency provision that can help you out with the cost variations.
Thank you very much.
You're welcome.
Okay. Any more questions?
Any more questions? If you have questions, you can also raise your hands up or mute you.
Mikhail, Temiday, do you want me to share the link right away here, or you're going to circulate it after the call, as you wish?
Please share. So
you can share it here. You can share it here.
Sure.
And also the name of the resource person you say we should always try to follow in this space.
Sure.
I think Edward
Bodmer. You need to invite him, by the way.
Oh, we will try. Thank you for that.
So I just posted in the message box.
Okay.
And I'm just going to put Edmund Bodmer's website as well. Let me see if I got it wrong. I think it's fine. Okay.
Okay.
And then
So
next. Yes, sure.
Okay, thanks. So if no question, okay, I think so. This Sadiq, you can unmute yourself. So
Yes,
the
thank you
answer.
very much once again. Yes. In a case where we have debt sculpting, in a case where we have a debt sculpting in a project, how do we put in all these processes of pro rata of the equity? How do we integrate it to debt sculpting? Since debt sculpting is usually tied to cash flow that the project is going to bring.
Yes.
How do we inculcate into it? Because it's like debt sculpting try to move along with the cash flow that may occur at a particular time.
Yes.
Yes, thank you.
Yes.
I just want a small clarification on that.
No, that's debt sculpting is a topic that I recently started kind of bringing into my YouTube videos, and I'm going to maybe have a webinar on it because it's a very important topic in project finance transactions. But remember, debt sculpting is mainly, you deal with debt sculpting for two things. One is to size the debts. Okay, so you say we look at the future flow of the project, and we know that the lenders, they have some requirements in terms of the debt ratios. So in order to make sure, we're going to see by how much can I raise my debts so that I can still satisfy the debt metrics that the lenders they require, together with the maximum gearing. So once you size your debts, that is it. Then the disbursement order has nothing to do with sculpting anymore, because debt sculpting is really mainly on how. So you basically know your debt size, and then sculpting is just to chop it off, right? To see, how am I going to spread it throughout the repayment period, okay? So it's beyond, it's after your debt is sized, but disbursement is about your debt and how you're going to spend it, how you're going to inject during the construction phase. Sculpting is how you're going to repay the debt during the repayment period. So they are two separate things. However, the sculpting has an impact on the debt sizing, and that is causing a lot of complexity when it comes to the project finance modeling. And that is a separate topic that we can discuss later. But it's, as I said, it's a very important topic.
Thank you very much.
You're welcome.
Okay, and just something I want to bring out from that, which thanks, Hedieh, for the question. It's the moratorium parts that come with most of this project finance funding. Is there like a blueprint of how it's usually done? Is it that although every lender is always willing to let the repayment start coming after project construction, or there's a way they prefer to always want the principal repayment to kick off?
Right. So for me, myself, when I start building a model and I don't have any information about what the lenders are requiring, what I do is that I put the grace period as 6 months past COD. Okay, so that's the things that I have seen in most of the projects that the lenders, they say, okay, when 6 months past COD, commercial operation day, you need to start repaying the debts, okay? However, this is different from each institution. For example, again, if you have a concessional loan, they might give you a more, longer grace period, or sometimes years, okay? But most of the, even development agencies like African Development Bank or like commercial banks, usually they go up to 6 to 12 months of grace period, which after that you need to start repaying the debts. So I don't know if that answered your question.
Yes, thank you very much. Yes.
No.
And just to be certain, it's the entire debt service, both the principal and the repayment and the interest that happens at that period, that starts at that period.
Exactly. But remember something, maybe in your financial models, sometimes you define 2 grace periods, one for interest, one for principal, because I have seen cases for like mezzanine provider that you can even have grace period on the interest, because for the senior lenders is most of the time is only on the principal, but you can have also grace period or capitalization period for your interest as well. So yeah, depends on the institution and the type of facility.
Great, thank you. I see Sadiq Sand is up. Oh, okay,
No,
it was
it's
earlier.
down now. It's down.
Okay,
Yes,
so
that's the question.
Okay. I know we are running. Yeah.
Okay, so just one more question, please. Where a project has a viability gap funding is being supported by government, for instance, maybe a project finance, preferably a PPP project that is being supported by government through viability gap funding. Does it have any effect on the way the equity side of the sponsors of the project? Does it have a way that it can be incorporated into an agreement with the lenders for a project that has a viability gap funding? Because I do know of a project that government is supporting, and they are now using government support to seek for a more favorable terms with the lenders. Yes,
Right.
I
Yes.
just want to.
Yes, I mean, PPP or not PPP, like I am mostly involved in IPPs, financing of the IPPs and the power projects. And all of the time, there is one side, which is the government, right? And the government, is the customer, is the one who's buying electricity from the sponsors, right? And so it's not involved directly as a shareholder, but it's involved as the contractor, the concessionaire in the project, right? So having this type of agreement is going to make you have a party involved, you have a partner involved that has a saying when it comes to in decreasing the tariff. So the advantage is that everybody around the table, they have a common goal, and the goal is to bring this project into operation, right? So everybody needs to do some sacrifice. It's not just like the equity needs to do the sacrifice, or just the lenders, or just the government in terms of tariff. So that's why it's the beauty of project finance, is that you have all these stakeholders that will come together with their advisors, with their all the team, and they're going to come and sit together and say, let's see how we can build this project, right? Let's see. And then there will be all these negotiations of, if things go wrong, how we can just secure ourselves. So everybody's trying to put the risk as someone else, and someone who can handle the risk better, of course. So I would say that, of course, you can have a better lending terms by nature of your project. If you can really, that's why, you in the infrastructure projects, you can have the development banks, right? The development banks will come, and they are not going to fund the project unless they are sure that the project has some development impact, right? So that's why they're going to give you a better terms, better than the commercial lenders, because they are also considering the development side of the projects. And yeah, I don't know if this is answering your questions.
Yeah, thank you very much.
You're welcome.
Okay. So one more question. So from Jacob. So Jacob, you can unmute yourself.
Okay.
Okay.
Thanks a lot for the presentation. It was quite insightful. I just want to write on the back of the question from the last question. It's similar to a situation that I'm facing at the moment. It's a PPP project, infrastructure, which definitely a social good. We have engaged some development banks. We had done our model that showed a break-even in year 7, in year 7.5, and will be cash positive by the 9th year. The PPP Office of Government that was reviewing our model saw the viability, and on the basis of that, wanted to shorten the concession period from the supposed 35 years to something incredible like 15 years. And, with regulators sometimes, because they are not in the finance world, they don't seem to comprehend the viability concept and the fact that there's a lot of equity play in the deal. And on the back of that, the government is part of the SPV. They own a certain equity stake in the SPV. So the PPP office are asking to shorten the term because they saw the viability of the project, and even asking for a fee because of the huge top line revenues they saw. So what sort of credible arguments I know it's a hard call for somebody who doesn't come from the same background as yourself, especially if you're finance, with a finance background. So what sort of the strong, simple, basic, points we can present that will, sink into their,
Yes.
understanding? Yeah.
Sure. This happens a lot. I have also come across, situations where, they were asked to, shorten the concession period. And again, the tool that you have to justify, the impact is the financial model. You can come and, show that, okay, so because when you negotiated the tariff, you had a financial model, and your financial model was considering 35 years of projections and a project with 35 years of revenues. So when you got your funding from the lenders, that was the consideration. So all these metrics, together with the debt metrics, they were based on this concession, the duration of your concession, 25 years. I don't remember, you mentioned 35 or 25 years. So you can just see, look at that version of the financial model, which was used, to come up with all the agreements with the lenders and the tariff that came from that financial model. And then just, shorten the concession and see the impact on these ratios. You see that the equity IRR is no longer the same. And that was the requirement from the shareholders, okay? So you need to somehow, show the impact on these different stakeholders involved and, come up with a solution, in terms of there is a need for an increase in the tariff if this is the case, because one of the things that is going to have an impact on the tariff is the duration of the duration of the concession, right? And that's a very important metrics, and you will see that the impact on the different metrics will be considerable, especially on the equity IRR, because these investors, they came in with that prospect, and it's going to be much difficult because they are not going to stay there for the life. Not most of them are going to sell the project at some point in time, right? So exiting with a project that has a 35-year prospect than something that has 15 years prospect is just completely different. And lenders as well. I mean, if you had a 35 years and all of a sudden you shorten it to 15 years, we should even see whether it's going to cover the duration of the loan, if so that's going to maybe requires a complete restructuring. So I would say just the simple, run of the financial model, looking at the impact of 35 years versus 25 years versus 15 years and showing all these scenarios. First of all, the impact if you don't change the tariff, and then by how much you need to raise the tariff with a 15 years concession to keep the metrics the same, right? So that would be my argument to start the discussion.
Thank you so very much. That helps a whole lot.
Welcome.
In fact, I used to, sorry to you, even the questions you plan, I don't know, maybe we'll combine it. She has done the session before. I was even trying to tell people in the community that, you have been involved in some interesting projects, in Nigeria specifically, and then some other African Development Bank infrastructure projects, So I'm sure people don't know that how much you even know about projects in our own side. Like you have experience. You've even told us one interesting one, where there was a particular line you saw and you were like, I've not seen this line before.
Correct.
And they had to explain to you what it meant in our own environment. So I don't know if anyone, because it's very rare. Let me just ask, how many minutes? I know you also have your own schedule today. What's the max, maybe do you have like 6 more minutes, or should we just wrap it up? I don't open the floor for more questions.
As you wish, I'm flexible. If there are more questions, please ask. You're welcome to ask questions. I can actually have, 15 more minutes. I'm completely fine.
Oh, thank you very much. So, audience, everyone, we have 15 prime, or let's say 13, so we don't overuse the generosity. I know some people in the house. There's John Ufelshi, who even lives in the power sector, and John, this is your opportunity maybe to ask some questions you might have that you think will help you tie what you see with maybe some other things you have seen. Who else do I want to call up? I also see your guy Alex in the house. You have any question? Okay, so while they are maybe thinking of their questions, because I know them personally and I know there are some overlaps in what you're saying and what their interest and where they and what they do is. So just to ask, I know some people in the house were not there in the first session. So you in your first session, you tried to show us a bit of how really development projects are picked, how you evaluate, and even share with us also too one of your very wonderful resource on eloquence. So I will just say maybe 3 minutes you can. Mr. Jacob, your hand is up, right? Should I still call you? Or it's a different, the previous question?
Oh, no, sorry, it was in error.
Oh,
I'm fine, thank you.
Okay. Okay. So my question is, almost all of us involved in project finance in Nigeria, if you see like 20 project finance, maybe 20 of them will be always having a development concept. In fact, most of the lenders, people who fund projects here in Nigeria, they are majorly people who run more to the development banks, because of some of what you said. So most people see that incentive to only want to undertake development projects. So it would be nice to hear from you. What are the kinds of things that plays in the real world in that space, from your experience as regards development projects in sub-Saharan Africa? What are those really interesting things, that made you really wanted to stay in Africa for that long? And you left Europe and you're like, yeah, this is where you achieve more impact. So we'll be interested in hearing maybe 1 or 2 around that area.
Well, to me, what I see, and that's why I want to stress, is really, the importance of having a good package when you're sending it to this different lending institution. Because I always say these people are busy, these investment officers sitting in the bank, African Development Bank, all these in IFC and all of, they are like busy people, these investment officers. They don't have time to go through a financial model and, check stuff. So when we are preparing the package to send it to the lenders, we always need to make their life easier, right? We know that they're going to also, to any investor, we know that, these people, they're going to take the project documents that we send them, and they have a long checklist of project documents, and they're going to take the information and they're going to summarize it into an investment paper that they're going to send to their board and ask for money, right? So in order to make their life easier, there are always tools, that you can include within the financial model, a project info memo that is well organized, containing the section that that they need to get approval in their boarding. So if you have such a package and you send it to me, it's going to really help, both in terms of, how they're going to see you, how serious they're going to take you. And they say, okay, so these people, they know what they are talking about, even by the quality of the financial model that you send to them, they're going to say, okay, so these people, they know. If not, if they really like the project, they're going to ask you to go and get a financial advisor to do this, because they understood that, you don't have it in-house to do it. So that's why I think, it's just, if you are a developer and you really need to invest, in a good financial modeler and in a good financial model, that's going to help a lot, even internally. It's not just for the lenders. We saw in this example that the impact of these different discussions that they have on the return, So if you have such a quantitative, tables that can tell you the way you need to go, the negotiation should go, it's always, easy. It's going to make the negotiation even easier, because sometimes we sit in the negotiation and, everybody talks, but once you sit in front of the numbers, they talk, so you can have much negotiation power when you have a good financial model. I always give this example. When I started working at the African Development Bank, my first project was the Henry Konan Bedie project, the third bridge of Abidjan. So it was at the latest stage of the project, and I just joined the African Development Bank. It was back in 2011. And so I was involved in the project, and the financial modeler from the sponsor side, which was Bouygues was the EPC and was also an investor in the project. So they had this guy, French guy, Romain, I never forget, his name. So he was there. He was actually negotiating for Bouygues. He was negotiating with the bank. I was at the African Development Bank at the time as a financial modeler. So he was in the afternoon, he had session with me on the financial model, and in the morning he had, sitting and negotiating, the contracts. And when I was looking at this guy, I was like, oh my God, this guy, I mean, wow, it's just, I was so amazed, that, he has both of these communication skills, negotiation skill, and financial modeling skills. And to me, that's the thing for anybody starting as a financial, in the financial modeling field. I think you mentioned, Temidayo, that we're going to have a question about what advice, I can give to someone. And that is something that I always ask people is, I tell people to please invest in yourself, invest in your communication skills, because we are learning, I am still learning about Excel every day, the technical skills we can learn and learn. But what I really wish I knew when I was younger is to invest in the communication skills and invest in myself, because that's what is really important. So it went all the way, but that's basically it.
Wow, thank you. So, Temidayo, maybe we'll combine the two questions together now and later answer.
Okay.
And then we wrap the session.
Okay. Nice one about communication. Okay, so I already told you before. So just go and tell us how you started your own financial modeling journey and what advice do you have for people just starting out in the financial modeling field. Have you got my question? I hope you got the question.
Yes, I got the question.
Okay.
Yes, I thought somebody else had a question as well. Okay, so listen, when I started off, I mean, I wanted to become an economist, and so I studied economics. But then, along the way, when I was doing my PhD, I started working, for my supervisor, which is Professor Glenn Jenkins from Queen's University of Canada. So I started working with him. He had some training programs that he was organizing around the world, giving training programs in investment appraisal, the cost benefit analysis and risk analysis to different, organizations like the African Development Bank, so all around the world. So I started traveling with him and, teaching these things. And it was just in 2010 that, he had a team of consultants based at the time it was in Tunisia. So that's why he put me in the consulting team that he had in African Development Bank. And I started working on real projects. And that's when I learned everything. To be honest with you, everything I learned at the university and all that was something. But what I learned when I was really working and struggling, to learn these things was really when I was working on real project. That's why when people ask me, how shall I learn financial modeling? I say, just get a real project, or just come up with a real example and start building it yourself from scratch, because working with templates is okay when you're already familiar. You need to build one model from scratch yourself. Then you can say, okay, I know financial modeling. And then from then on is learning. But just building that one model yourself, and then if you can use it to negotiate contract and get feedback from that model from the different stakeholders, then that's it. You're just starting off your journey as a financial modeler.
Awesome. So, Hedieh, I want to say thank you.
Yes.
Awesome. I want to say thank you for honoring our invitation, and I want to thank everyone for coming. So, Mike, you don't say anything?
Yes, thank you very much, and we hope to have you again,
Sure.
in the future. And it's a very wonderful session. Thank you for the extra time you give us, and to everyone, thank you for joining. Have a very wonderful week ahead. Thank you very much, Hedieh.
Thank you. No, thank you for having me for the second time. Thank you.
Okay, so bye to everyone.
Bye.
Bye.
Bye, everyone. Thanks, Hedieh. Thanks, Michael.